Welcome to Sectors Up Close. I'm Elena Casas. Today we're talking UK traded miners, and my guest is Chris Beauchamp, Chief Market Analyst at IG. The green energy revolution was supposed to spark a cash bonanza for miners, as electric cars require lithium, nickel and cobalt that are in short supply around the world, and copper is crucial for wind turbines and solar panels. The problem is that much of the market in processing those metals has been cornered by China, which produces at least 80% of all solar panels and 60% of wind turbines and electric car batteries, meaning the slowdown in Chinese manufacturing has hit miners around the world. Well, this is the FTSE 350 Industrial Metals Sub-Index, down over 20% this year after substantial falls in Rio Tinto, Glencore and especially Anglo-American, which recently cut dividends by more than half as core earnings slumped. To dig into the sector's woes, I'm joined now by Chris Beauchamp of IG. Chris, hi, thanks so much for joining us. Why then have the miners not seen the boom in materials prices from green energy that many analysts were expecting?
I think it's that object lesson in not following the hype. Maybe expectations were too strong at the beginning of the year, and inevitably once the Chinese data failed to follow through, once you had that sort of lack of rebound and those big concerns about the Chinese economy, it meant that the sector saw those big falls. I think the pessimism certainly returned and money just shifted elsewhere, I think, essentially. I think maybe it starts to come back from this point onwards because there are signs of a recovery. The stimulus efforts from the Chinese government could begin to bear fruit in the next 6 months. So maybe now is the time to look at it more than it was even a year ago.
If we don't see a rebound in manufacturing in China, can that be compensated for elsewhere in the world? There is a drive, isn't there, in the US and in Europe to bring a lot of that manufacturing back to their own countries and away from China.
That's the sort of the second string to the bullish thesis, I think, really, that you see that improvement in demand in the US and in Europe. And to be fair, again, the signs are looking up there as well. The Fed, of course, rowing back on its worries about recession. They're talking maybe about soft landing being a distinct possibility. So that should support investment in those capabilities too. So again, in some ways, of course, the standoff between the US and China can be quite beneficial for the sector because it will mean that these capacities have to be brought home to developed economies. So even with the Chinese weakness still persisting, there are reasons, I think, for optimism.
Are some of the FTSE mining giants healthier than others?
I think still looking for the broad-based ones, or as ever, Rio and BHP, the ones that we should continue to look for, really. Even Anglos, though, I think there is more room for upside there. I think looking at the valuations, really, is something to bear in mind. We're not talking about a rebound in 3 months, but looking at a year from now, I think the miners are actually quite well placed to do well.
Are certain metals oversupplied, though, now on the international market?
Oh, yes, I think we're still seeing that being worked out, really. Again, it's that function of people investing too strongly earlier in the year, plentiful supply, especially in copper. I think it means that you've got, again, that lag to be worked through. So we're not talking about looking for this for short term, we're looking at this for at least a year. But nonetheless, I think the prospects of the sector do look reasonably attractive.
So from an investor perspective, then, not a bad buy, despite the fairly bleak year to date?
Yes, I think it always makes sense to look at the sector more now than it was perhaps 8 months ago, when there, again, was all that hype surrounding hopes for China that refused to materialise. In some ways, it mirrors, I suppose, what we had with tech last year, that sentiment couldn't get much worse than it can now. And I think that just gives you that room to say, well, the margin of safety, perhaps the risk lies to the upside for these stocks.
Do you think, though, that the way in which China has cornered the production of a lot of green energy tech and the processing of certain metals is worrying going forward for the sector? Are we too dependent on one country?
Yes, I think so. And again, it's this outworking of the US-China competition. Perhaps that will benefit us, but that kind of long-term capacity generation in the US will take time to appear. But perhaps that still gives you, again, that longer-term story for the sector that it's been missing for about a year or so.
Chris Beauchamp of IG, thanks so much for that insight. Well, that's our look at the mining sector. I'm Elena Casas, and this is Reuters.